It's one of the 20 largest companies in the world, but it only has $4 billion or so of revenue.
They're some of the most popular names in the market right now, but several are showing signs now might be the time to drop out.
Congratulations if you caught this rocket ship, but it's time to get off. There's nothing I see that comes even close to justifying a $1.5 trillion valuation.
Whitney Tilson with Stansberry Research shares his 3 stocks to drop in the new year and 3 stocks he's looking to buy.
It's one of the most speculative stocks I've ever recommended. I've never seen such a big disconnect between the underlying performance of the business and the stock price.
Will any of these names make your buy list for 2026? Let's dive in. Excited to continue our series in Vegas with Whitney Tilson with Stansberry Research. Whitney, I loved your speech you just gave on stage a minute ago. You are going to share today with our viewers 3 stocks to buy and 3 to drop for 2026. Before we get into those names, I want to hear just your outlook for the year ahead, especially given the market's at such highs right now.
The big picture is, as I said, I'm still constructive on stocks. I do not think we're in a bubble, and a lot of people think we are because of particularly in artificial intelligence, which has been driving so much of the market, and valuations by any way you want to look at it are at or near all-time highs. But I don't think we're in bubble territory, and I think the underlying economy is still pretty darn strong. Clearly, job growth is slowing. The economy is slowing a bit, but from a very hot level. And so I think, look, when you're in a bull market, you got to ride it. And once 1 year out of 10, maybe, there's a real bust. And trying to anticipate, the peak of the housing bubble, the peak of the internet bubble, where you really do want to get out, is an important part of what I do, and I look for the signs. And there are some warning flags out there, but I think we could still even have a melt up before, bull markets tend not to end with a sharp meltdown, but rather you get a melt up into bubble territory, and then you got to get out because that bubble's going to burst. This reminds me of early 1999, not early 2000, for example.
So there's still time before that happens. I do think the really interesting thing are the 3 drop lists you have. You have some interesting names, so make sure you stay tuned until the end to get to all of those. But let's start with your buy list for 2026. What's that first company that you're looking to buy in the new year?
Sure. Well, why don't I start with, I pitched a stock that I pitched here 2 years ago that I still like, 1 year ago that I still like, and a new stock. So let's start with the oldest one first that's really worked out wonderfully, Joby Aviation. It's one of the most speculative stocks I've ever recommended. They make electric aircraft, and it's a very emerging technology. They have not yet begun flying passengers commercially. They don't yet have FAA approval, but they're going to start flying in Dubai, between Abu Dhabi and Dubai, probably early next year. And the stock has tripled on investor enthusiasm for the progress they've been making toward launch of commercial service. But I think when they actually do launch commercial service, it's probably got another double in it. So it's only got a $15 billion market cap today. And so I think either the business works and the stock's a buy, or any number of companies could come in and buy them for their engineers and their technology. For example, Joby has 1% the market cap of Tesla. And so, they're developing electric motors, batteries, things that have applications, outside of their core business. So I think you got to have a win-win there.
Well, first off, congratulations on the win of recommending Joby 2 years ago.
Right.
That would have been a great time to get it on this stock. I think also you made such an interesting point that this is coming soon. The commercialization is happening soon, but we're not there yet. We've seen some volatility in Joby and Archer this year because there'll be excitement, there'll be new headlines, but it hasn't happened yet. So when do you think that we could see? Is it in the next year that we could see that doubling again in the future?
Yeah. Well, look, I can't claim to be the world's greatest timing, having the world's greatest timing on Joby, because the stock was flat for a year and a half, bounced around, but basically was flat around $6 or so. And then suddenly it went to 20. Today it's around 15, 16. It's hard to know, but I do think initiating commercial service, which is scheduled early next year. They've already got the approvals in Dubai and all. It's not as rigorous an approval process as it is here. And then probably a year to 2 years from now, they get FAA approval and can start flying in the United States. I visited the company, spent a whole day there a couple years ago with my cousin, who's a Stanford engineer. He knew all the engineers at Joby, and he said, this is the greatest collection of mechanical, electrical, aerospace engineers in the world. And that's what got me over the hump to buy something that doesn't produce any revenues at this point. It's speculative, so you should size it appropriately.
Yeah, a really interesting first company. It's a very popular name, and good to know that you still see some growth ahead for this one.
Oh, yeah.
Let's get to the second company you're buying in the new year.
Sure. Last year, I recommended Match Group, which has the dating site Match, but also owns Hinge and Tinder. And these are good businesses. There's no CapEx. They just operate a website, and people can meet each other. And the stock's much more. This is a classic Whitney stock in that it's beaten down, it's out of favor, but it produces a ton of free cash flow, and it trades at 8.5 times next year's earnings. They produced in the last 12 months a little over $900 million of free cash flow, and they spent $876 million buying back their beaten down stock. So they reduced their share count by 9% in the last year. But meanwhile, the business is sort of flat. I would not say this is a melting ice cube, but they need to show some growth. But in the meantime, they're paying you a 2.3% dividend, buying back 9% of their stock, trading at 8.5 times next year's earnings. It's a market leading business in it's got very attractive economic characteristics. There's no CapEx or anything like that. So this is one, since I recommended it a year ago, it's down 14%. So that's not great, but it's not, this is the kind of thing where it could take a little while to work, and then they report 1 quarter of 5% revenue growth and operating income growth, and the stock could be up 50% in a matter of days. But I can't predict exactly when that will happen. But this is a classic, value stock situation that I like, and the key is they're a market leader, and they generate a ton of cash, and they're returning that cash to shareholders in a very sensible way. When you got a beaten down stock like this, buy back all the stock you can.
This is such an interesting one, a very different philosophy than Joby, right? Joby's that more
completely opposite.
This is very different. My biggest follow-up is, what gives you confidence that they will see that turnaround? What will it take to give them the numbers that we're looking for to really turn the stock around?
They've got a new CEO in who's laid out a plan. The business was not particularly well run. The websites, there's so many scammers and catfishers and all that make being on these dating sites very unattractive and all. And so I think he's taking the right steps, but it's going to take a little while. The good news is the year-over-year comparisons are pretty easy because the business hasn't been managed very well, and it's been sort of stagnant.
Okay, interesting second pick on your buy list. Let's get to the third company that you were recommending.
Sure, this is one I haven't written about before, but it's called Global Payments. GPN is the ticker. And if you think of the whole world of anytime you use your credit card, there's a whole series of, you have Visa and MasterCard, two of the greatest businesses of all time, that are pocketing part of a good chunk of that credit card fee. But then there's also another category called merchant acquirers that take a very small piece of billions of transactions. All of these businesses are very good businesses. But Global Payments, if you look at its earnings, its profits, its free cash flows over the last 20 years, it's just gone up and up and up. And 99% of the time, over an extended period of time, the stock will follow the performance of the business. But in this case, the last 4 or 5 years, there's been a total disconnect. The stock was, a great growth stock tracking earnings. In the last 4 years, the stock's gotten cut by more than 50% while the business has continued to grow. And so what used to be a stock that historically is traded at 19 times forward earnings is right now trading at 6.4 times next year's earnings. So I've never seen such a big disconnect between the underlying performance of the business and the stock price over a multi-year time horizon. Global Payments just acquired, they were the number 4 player in the merchant acquirer space. They just acquired WorldPay, the number 3 player. So the combined company, when the deal closes early next year, will become the number 1 player. And this is a business in which scale matters. It's already a very high margin, 45% EBITDA margin business. By combining and being able to cut costs and so forth, it's going to be a 50% EBITDA margin business. So this is a business that has margins that are approaching Visa and MasterCard, which trade at 35 to 40 times next year's earnings. And this business trades at 6.4 times next year's earnings. So I think Once you get through the acquisition and they continue to grow, eventually the stock will reflect the fundamentals. I think it trades back to 19 times earnings, forward earnings, like it has historically. And that's a triple just on the multiple. And then you have earnings growth on top of that.
Yeah, these numbers are fascinating. I love digging into the numbers a little bit, but I want to talk about the why. I think when you have a company like this that's seen earnings grow and the stock is not following suit, why?
Yeah, why is there such negativity? It's a variety of things. Investors are concerned that the WorldPay acquisition, that they overpaid and they're using a depressed stock to make for most of the acquisition. So investors aren't happy about that. The company had promised to just buy back stock like crazy. And then this WorldPay acquisition opportunity came along and they took it, but that isn't what they promised investors. So investors are punishing them for that. There are smaller competitors like Square and Toast and all that are coming in offering new payment services to small and medium-sized businesses. Investors are worried that that could be a headwind, but we're certainly not seeing it in the numbers. They've got to do a big integration of a big acquisition that, can sometimes cause some short-term hiccups and so forth. And the company has $14 billion of net debt. And on a $21 billion market cap. So it has some debt, but given the incredibly high and steady cash flows of the business, it's not a worrisome amount of debt. So there are a variety of things that I could understand, the stock trading down from 19 times to 15 times next year's earnings or something. But the overshoot down to 6 times next year's earnings is totally unwarranted in my opinion.
Such an interesting buy option to look at. It's this company we've not talked about on the channel yet. So thanks for bringing it to our attention.
And by the way, we recommended it in our June issue of Stansberry's Investment Advisory. And, the stock is up 14%, S&P's up 13% since then. So it hasn't run away from us. But anyone who's a subscriber to our flagship newsletter there can just go into the archive, just log in, go into the archive and read our June 5th newsletter in which we lay out the whole case on global payments.
Yeah, such an interesting company. And I know that the drop list you have for us is even more interesting. I can't wait to get to these names. First, if you want to learn more about the stocks we've talked about, these first 3 and the next 3 coming up, you can check out the Stansberry scorecard on all 6 of these stocks for free right now. You can just scan the QR code or click the link right in the description of this video to get more information about all of these stocks and some of their proprietary knowledge and research behind these companies too. Again, you can scan the QR code or click the link right in the description to get access to that right now for free. Well, Whitney, let's get right into this drop list because this is interesting and I think some of our viewers might have something to say about a few of these names.
Sure.
What's the first company that you are looking to drop?
Sure. Well, let me frame this a little bit in that I perhaps am best known for being an activist short seller over the years. I went on 60 Minutes and took down lumber liquidators back in 2015. I warned people about the bursting of the housing bubble, was on 60 Minutes on a segment that won an Emmy in late 2008. But I will say that short selling is very difficult. I wish I'd never done it, and I don't recommend that 99% of investors should just never, ever short a stock ever. It's just too dangerous. It's too hard. But I do, in my investing dailies and in the presentation I just gave, warn people about stocks that I think are overvalued that you should avoid. And so these are not short recommendations, but I did share with the audience my number 1 stocks to avoid. So top of the list, Palantir Technologies. It has grown and the stock is up to a $423 billion market cap. So it's one of the 20 largest companies in the world, but it only has $4 billion or so of revenue. It trades at north of 100 times revenue, this year's revenue, over 200 times this year's earnings. So the company has a good story. It's riding the AI wave, it's riding the defense tech wave, it's riding the relationships with the Trump administration wave. And so it's got all these tailwinds, but the investor enthusiasm for the stock has propelled it to a valuation that it is the single most overvalued big cap stock I've ever seen in my career. It's probably, even giving the most generous valuation and the most generous assumptions on the business's performance, it's 4x overvalued. If you've owned it, you've had a great run on it, congratulations. Maybe put in a very tight stop loss or just take your profits and count yourself lucky. You lucked into one of the great overvaluation moonshots I've ever seen.
We have a lot of early Palantir investors here who have made a lot of money on Palantir.
Sure.
But so many of them are confident that this company can continue to grow even more. Do you see the growth happening?
Yeah.
Or do you think it's just going to never quite reach the valuation it's at now?
Right. Both. I think the company is guided to, they just reported earnings up 48%, revenues up 48%. So there's definitely a growth story here. But that might warrant 20 times revenues, 25 times revenues, and it's trading at 102 times revenues. So I cannot see any scenario where this company can grow rapidly enough to justify its valuation. It reminds me of Cisco back at the peak of the internet bubble in 2000. Cisco was the dominant company making routers then and now. 25 years later, this company's done great. Earnings have gone up over the years, and the stock went down by 90%, and it still is not back to where it was 25 years ago because it was trading at 180 times earnings at the time. Palantir today has somewhat similar market cap, $400 to $500 billion, which is important just because it's hard to grow once you're that big. The valuation is even more extreme, over 200 times earnings versus, Cisco is 180. That's what happens when you get a mega cap company trading at such nosebleed valuations.
You made some really great points about this one. I'm excited to see what our viewers have to say in the comments too about this one. Let's get on to the second stock that's on your drop list.
Sure. Well, it's another popular one that I'm sure many of your readers made a lot of money on, AppLovin. It's got over a $200 billion market cap, trades at 63 times this year's earnings, 36 times revenue. So the valuation isn't as extreme as Palantir, but it's still extreme by any other measure. And a number of well-respected activist short sellers, not one, but like 3 or 4 or 5 of them. And these are people I know, and I know the work that they do, have exposed all sorts of sort of shady business practices. You go to download the app and they sort of trick you into downloading things and they bombard you with ads and so forth. So unlike Palantir, where I haven't heard anyone critiquing the business, AppLovin seems to be engaging in a lot of sort of pushing the envelope / shady practices that I think could really trigger a big sell-off here. And so the stock's been an absolute monster. Congratulations if you caught this rocket ship, but it's time to get off.
All right, another good one for the drop list.
Sure.
You made some good points on that.
Right.
Let's get to the third one.
Right. Let me get to the stock that will really make all your readers spit up their coffee, which is Tesla. I long ago was short Tesla very painfully, and I have long said do not short Tesla at any valuation. But I think it's reached a point where you want to be taking some profits on it. The valuation is $1.5 trillion, and their core business is obviously selling vehicles, is facing 2 massive headwinds, which is one, in the United States, the $7,500 tax credit just went away. So there was a big surge in buying. Anybody who wanted to buy a car did so by September 30th, and that helped Tesla make their numbers here in the US, but that's gone away. So I think you're going to see a huge drop off in US car sales. And then internationally, the Chinese EV makers like BYD and so forth are coming out with good electric vehicles priced as low as $8,000, like 80% less than the cheapest Tesla. And they can't import into the United States because of our trade barriers, but they're importing everywhere else in the rest of the world. Go anywhere in the world. And Tesla has small and shrinking market share, and the Chinese are just taking over, both in China, in Europe, in Mexico, et cetera. And so I think you're going to see a huge decline across the world, US and worldwide, in Tesla's vehicles. So the Tesla bulls are like, that doesn't matter. We've got the Optimus robots, the humanoid robots. I'm skeptical whether that's going to be a big enough business to make any impact on a $1.5 trillion valuation. And then, of course, the enthusiasm is over the robo-taxis that Elon Musk has been promising for, 5 years or more, all these self-driving taxis and all. And they now have robo-taxis in Austin, Texas. but I took a ride in a Waymo robotaxi 5 years ago, and it had a safety driver there to intervene as necessary. And that's where Tesla is today. Tesla today is where Waymo was 5 years ago. And Waymo, I just rode in a Waymo in San Francisco that has no safety driver, and it was a beautiful experience. And one of the reasons I'm bullish on Alphabet is I think you're getting a nice free call option on Waymo. But Elon Musk, I think, promised that by the end of this year, half of the United States, half the population of the United States would have access to Tesla robotaxis. And I think they're going to have 24 in Austin by the end of this year and will not get permission to remove the safety driver. That's going to take years, I think. So I just don't see. So I think when investors wake up to the reality of cratering sales in their core business, and it's going to take much longer for these new emerging businesses to grow, to be material in the context of one of the highest market cap stocks in the world. I think there's a lot of downside to this stock.
So many great points on Tesla. I have one follow-up. The biggest one you already addressed, which was Optimus. There's people excited about Tesla are excited about Optimus.
Yeah.
Do you think it could take a long time before Tesla sees any profit from the Optimus?
Yes. There are a number of other companies. In fact, one of the speakers earlier today showed some examples of some other humanoid robot companies that are out there getting a lot of funding. So I think it's going to be a competitive space. I'm excited about it. I've seen the cool videos. I'm a little suspicious about, I think they're really human beings inside some of those robots. You know, I'm not accusing Tesla of that, though I will say during one of their investor days of some sort, it turns out they didn't have humans inside the robots, but they had a human controlling the robot. It wasn't really an autonomous robot. I think it is an exciting new area. And as I talked about in Joby, like I'm now, as an old school value guy, I am willing to do a little speculating on emerging, exciting technologies. But I'm also cognizant of the fact that, you know, things take twice as long, cost twice as much, and there are going to be twice as many competitors as the most conservative estimate. I think Tesla's power pack business, you know, their energy storage business, you know, that business is probably their second largest business and might be a decent business. Tesla's doing reasonably well there. And I think the robo-taxis are going to take a number of years before that materializes. And then these Optimus robots are just sort of a little skunk works on the side as best I can see it. But, you know, there's nothing I see that comes even close to justifying a $1.5 trillion valuation.
All right. Interesting debate. I'd love to hear what our viewers have to say on Tesla, all of his drop list. Whitney, thank you so much for giving us all these names today. And again, let us know your thoughts in the comments. A lot of stocks and a lot of different subjects that you can comment on. Let me know your thoughts in the comments. Thanks again for joining us, everyone. As always, happy investing.